John Ragland, thank you.
Thanks, Brad. And great to be with you. I stand between you and lunch, so I'm going to actually just say my conclusions first in case attention wanes towards the end. But I think that the U.S. retail sector, it's large like all of the other sectors you've heard about. It's very diverse in terms of the product types that are invested in. So most of you all think about high street and malls, but there are grocery anchored centers, there are power centers, there are entertainment centers. So it's a very diverse sector. It's a sector that's getting confronted with headwinds. There's disruption. There are disruptions in all of these sectors, but in the retail sector, you've being hit with technology advances, you're getting hit by e-commerce, and you're getting hit by retailers that are really changing their business model because of e-commerce and technological advances. But I think certainly the conclusion that you should reach by the end of this is that disruption is actually creating opportunities for both retailers and retailer investors in the U.S. over time. And so I'm going to start very broad. So this is this comes from Real Capital Analytics, and this is basically a profile of the retail industry across the U.S. in terms of transaction activity against all commercial transactions over the course of the past 11 years or so. And essentially over the last 5 years, retail has represented about 25% of all of the transaction activity. The transaction activity today is actually more than it was prior to the great financial crisis. So retail investment is in great demand in the U.S. today. So of that total retail pie, I'm going to talk now about open-end funds. And open-end funds represent about 2% of that overall pie, but it's a sector that we have a lot of transparency into. And you can see through this slide that I talked about the diversity in retail investments. So within the Odyssey Fund that represents 367 shopping centers, over 50% of them are in grocery anchored centers. You've got about 12% of them that are in regional malls. There's no real category for urban. It's combined with single tenants in suburban areas. It represents only about 11%, but urban as a part of that is probably less than 5%. So you can see that there are lots of options for retail investment activity in the States. I think that if you look at the distinguishing characteristic of retail within the context of the other property types, there's been less volatility in retail over the last 20 years than any other property type. And I think the cash flow component of the total returns have been anywhere from 9 to 12%. Cash flow has been more than about 50% of that, and retail has typically outperformed the other sectors because you've got long-term leases, and you basically also have, this is comprised of leverage that's about 30%. So once you get outside of the core specific strategy and apply greater leverage, obviously you can enhance your returns. But there's also an element of this. I think retail has lower capital requirements than the other sectors as well. So the long-term leases, 10 years or more, low capital requirements, less than 10% of NOI, keep cash flows very consistent for retail properties. We've talked some about pricing today. We think that particularly in the core retail sector, that pricing will remain where it is today. There's tremendous demand for core retail, both amongst domestic and foreign groups. There's about a 225 basis point spread today between treasuries and where cap rates for non-mall properties are. The spread's been less than that in the future, and there continues to be demand for core property, and the problem is that it's difficult to access core retail property in the States today. Goes back to the earlier chart with respect to the dry powder that's out there for core retail. So I think that we've heard a variety of different projections in terms of household growth and average wages. We see them all continuing for the next 24 to 36 months, and it will lead to a sustained amount of consumer spending. Consumer spending is 2 to 4% growth a year. We anticipate that will continue to be true in the future. The thing that is really driving the operating fundamentals in the States for retail is the fact that we've got a historic low growth of supply right now. The growth of supply is less than 1% of the existing building stock, and we really don't see that changing too much in the future. The slight uptick that you see in 17 and 18 here will be build-to-core, and it will be primarily build-to-core with supermarkets and with outlet centers. And outlet centers really hasn't been an institutional property type, but I think it will be in the future. So as a result, you've got occupancy levels today that are at 93 to 96%, and you've got NOI growth that for the good properties that is at 3 to 4%. We see no real change in the fundamental in those characteristics going forward over the next couple of years. In terms of market selection, retailers have really come to, and we'll talk a little bit about e-commerce in just a few minutes, but retailers are looking at markets with high affluence and high education levels, and they have focused on super zips as sort of a characteristic of their market selection. Many investors do the same thing. Green Street tracks the proportion of certain public companies' exposure to super zips when they evaluate their retail portfolios. And the reason why is that on average, retail assets in super zips outperform retail assets in non-super zips by about 160 basis points over the course of the last 15 to 20 years. Where can you find super zips? You can basically find them in 30 markets across the country. So it goes once again to, I know a lot of Europeans focus on the 10 top cities. We really focus on the top 36 cities in the US where we think that there are very attractive retail fundamental opportunities and where there are clusters of super zips. As you can see here, we've had conversations about where the growth's occurring. Growth's really occurring in the Southwest, the South, and the West. E-commerce, so that's the big topic of the day. So e-commerce represents about 8.5% of total retail sales in the United States. It's growing at about 15% a year. If you look at some of the retailers will tell you, 15% of their sales are e-commerce, and they're growing by 20% a year. But the one thing that's not really talked about in great depth in all the newspaper articles that are out there is the stores remain the fundamental driver of e-commerce sales. If you look, 2/3 of all of e-commerce transactions involve a trip to the store either prior to the purchase or after the purchase. Prior to the purchase for research, after the purchase because 40% of all online transactions get returned. How are they going to get returned? Consumer doesn't want to pay for packaging costs to send it back to the retailer, so they bring it back to the stores. So the stores they are a primary driver of online sales. If you look at how retailers are reacting, you're going to have some retailers fail, as you have in all cycles, but you've had new retailers growing up. A lot of the pure online retailers, they can't make a profit by just selling online. So they are currently in the process of opening new stores. Amazon is a perfect example of that. Amazon is driving a lot of the new logistics trade. But Amazon is also, they've opened in bookstores. So they killed the bookstore business in the US through the online business, and now they're opening bookstores. Amazon Prime, they're also opening grocery stores, and you don't actually have to check your goods out in the grocery store. You use an app where you take groceries off the shelf, and it gets charged to you when you get home. They are actually revolutionizing the grocery store business in the US as well. They're also renting lockers in regional centers and in lifestyle centers. So Amazon is taking advantage of the full spectrum of physical store opportunities as well. So most of the questions I faced in talking to you all and at MIPIM over the course of the past week has been, what impact is this having on location? What impact is it having on store size? What impact is it having on lease structure? And I would say once again, retailers are looking to go to core locations where they have neighbors of complementary retailers who are doing strong volumes. So they are looking at the best locations, and they're looking for a massing of other retail. So location is extremely important, and they're going away from B and C locations towards A locations. When you take a look at size, wide variations in terms. Some retailers are growing from 10,000 square feet to 50,000 square feet in order to be showrooms. Others are going from 10,000 square feet down to 1,500 square feet. Bonobus, you can't actually walk out of a store with an article of clothing. You go on there for a fit, and then you walk out of the store, and it's delivered to you at your home. They don't report sales to the landlord, but they pay top dollar rents in the regional malls. So what we're also seeing in terms of lease structure is that in the best locations, lease rental rates are actually going up. You're seeing positive spreads of 10%, 15% in the best centers. So this e-commerce revolution is not impacting the economics of the best centers that you have. And I think that essentially what retailers have come to the conclusion is that they need to go from a four-wall strategy to an integrated model where they are using the store, the website, and mobile in order to effectively drive their sales. You'll see in your books Chico's, which is an apparel retailer. If the annual spend of people that use both their website and also go to their stores, it's 5 times greater than those that use online only. And once again, the profitability of delivering and then dealing with returns from e-commerce once again puts the store at the primary point of creating a profitable retail operation for retailers. And one other statistic that's also if a retailer does not have a store in a marketplace, they open a store in that marketplace, their online sales will increase by 30 to 50%. So I think that core retail is very highly sought after in the US for these reasons, that it will become the mechanism by which retailers respond to e-commerce. It is also, we've got strong operating fundamentals, limited new supply, sector diversification. There's a fair amount of market transparency. And I think that, once again, the low level of volatility that we've seen historically, I think that retail will continue to perform through up cycles and down cycles in a fairly consistent manner if, once again, you're pursuing a core or a core plus strategy. So, thank you, Brett. Yep.